Good morning. Today's topic is when can you close a solo 401k? We're going to discuss this at great length. Also, go ahead and type over questions you might have regarding today's topic. It doesn't have to be specific to today's topic. It can also be surrounding other aspects of the solo 401k plan, as well as even self-directed IRAs, the business financing 401k, and even traditional 401k plans. We'll answer those questions as they come in. Looks like we have a question already. Let's take a look at that question. I want to transfer funds from a traditional IRA to my solo 401k. How do I do that without making it appear as though I made a withdrawal from my traditional IRA? Great question. We actually did a live webinar a couple of days ago on this particular topic. So what we can do is here at my solo 401k financial, we obviously offer the solo 401k, and we assist clients in not only establishing the plan, but also in funding it, whether it's by helping them calculate annual contributions or helping to transfer funds from an IRA or a former employer plan. So if you have an IRA at Fidelity, you just need to provide us with that account statement for your IRA, as well as Fidelity's IRA transfer form. Fidelity will provide those to you, and then you upload those back to us, and then we'll prepare that IRA transfer form and make sure we check off the applicable boxes so that it is treated as a direct rollover. A direct rollover is when an IRA is transferred to a employer plan, whether a traditional 401k or a solo 401k plan, where the check is made payable in the name of the solo 401k plan for your benefit, since you're the trustee of the plan. You then deposit that check directly to the solo 401k bank or brokerage account. So you do not deposit the check to your personal bank account. When it's processed as a direct rollover, in this instance, Fidelity as the IRA custodian will report that movement of those funds from the IRA to the solo 401k as a non-taxable direct rollover on Form 1099-R using a code G as in George in box 7 of that Form 1099-R. In box 1, they'll list the total amount transferred from the IRA. Box 2A will have a 0. Box 2A communicates to the IRS that none of the amount transfer was taxable. So Fidelity will issue that Form 1099-R for that IRA, since they're the IRA custodian, by January, February of the following year. For example, here in 2025, if you transfer that Fidelity IRA to the solo 401k as a direct rollover, Fidelity will issue that Form 1099-R in January, February of 2026, and they will also send a copy to the IRS, and they'll provide you with a copy as well. So that's the best way to move funds. And when it comes to moving funds from an IRA to a solo 401k plan, most IRA institutions will not send the funds electronically unless the IRA is also at the institution where you decided to use to hold the solo 401k funds. For example, many of our clients use Fidelity Investments to hold the funds for the self-directed solo 401k that we offer. Yes, you heard that right. Even though Fidelity offers their own solo 401k plan, they also provide what they refer to as non-prototype brokerage accounts for a plan offered by a provider like my solo 401k financial. And we'll help you open up those brokerage accounts at Fidelity. And if your IRA is at Fidelity as well, we can prepare the internal transfer form where the securities and the cash in the IRA can be moved over internally to the new brokerage account at Fidelity for the solo 401k offered by my solo 401k financial. That way you don't have to liquidate your positions. So good question. Okay, again, please go ahead and type over your questions during today's live session. Today's session is the topic for today's session, I should say, is when can you close a solo 401k plan? So thinking about closing your solo 401k, maybe your business has changed, maybe you are retiring, or maybe you've moved to a new retirement plan. But here's the tricky part. You can't just shut it down whenever you feel like it. There are rules, deadlines, and consequences that you need to know. So in short, closing a solo 401k plan is not just a matter of moving the funds out of the plan. One, you got to make sure you qualify. Second, you have to make sure that the required IRS reporting is done with the government. So here's the thing. Many people assume closing a solo 401k is as simple as pulling the plug. But the truth is, if you miss a step or file late, you could face IRS penalties or unexpected taxes. And we definitely don't want that to happen to you. So we're going to unpack this today. When can you close a solo 401k plan? Let me share some slides here. Please like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our YouTube channel, as it helps to get the word out to other solopreneurs like yourself as well. And we go live typically every day, at least once a day, oftentimes twice a day. For instance, today we'll be going live again here in a couple hours, or a few hours. So make sure to subscribe to our YouTube channel. Here's the address to it. You can also access our video catalog. We have over 900 videos there covering all aspects of retirement accounts. You can also visit our community page. Here's the address for that. You can post forums. We have over 30,000 members there. You can post forums. You can also even share your knowledge by posting guest blog posts. Many advisors, CPAs, attorneys will post blog posts on our community so that they can get their knowledge out there and their company out there. And it can be any aspect of small business planning, estate planning, insurance, advising. I mean, any aspect of small business information, you can post blogs about that. And the great thing about it is that you'll be getting your work out there by posting blogs on our community, guest blog posts. Your information will be presented to thousands of members of that community, and you can even link back to your website so that they can explore your services in more detail, and it's free to join. We also have our artificial intelligence, which is www.solo401k.ai. Take a look at that as well. All right, so again, go ahead and type your questions over to today's daily webinar, and we'll answer those questions as they come in. In the meantime, let's continue with today's topic. So thinking about closing your solo 401k, again, you can't just shut it down whenever you want. There are rules, deadlines, and consequences. So in today's session, here's what we're going to be covering. Let's start with bullet point number 1. Reasons for closing. When it makes sense to close a solo 401k plan. So here are some reasons to close your solo 401k. Reason number 1, you permanently ceased self-employment activity. In other words, once you stop being self-employed, you can no longer continue with that solo 401k plan, especially if you close your business down. So that's one important item to understand, that once you cease self-employment activity resulting in the closure of your business, you can no longer continue with that solo 401k plan. As a matter of fact, you are required to close it down. And that makes sense if you think about it. For example, I often get the question, well, why do I have to close it down? Because I used to work at, so like a client will say, well, I used to work at Microsoft and I participated in Microsoft's 401k and I still have my form, and Microsoft is now my former employer plan, but I decided to keep my funds in that Microsoft 401k plan. So why do I have to close it down if I have a solo 401k plan? Well, the answer is because without a without a business, you cannot have a solo 401k plan. So when you close down your self-employed business, you no longer have a business. So when you left Microsoft, obviously Microsoft did not close its doors, so they can continue offering a 401k. But if you compare that to your self-employed business where you close your business, then there's no business. And without a business, there cannot be a solo 401k plan. So that's a big difference. And we're going to talk further as to what are your options when you close a solo 401k plan. Here's another instance. You hire a full-time non-owner W-2 employee. Keep in mind that a solo 401k plan is for owner-only businesses that do not employ full-time W-2 employees, otherwise known as common law employees who are not owners in the business. So if you have a W-2 employee who's not your spouse, because there's a spousal exception, you can still continue with the plan if your spouse works in that business, and your spouse can even participate in the solo 401k plan. And again, we've done many live webinars on that topic. And if you visit our YouTube video catalog, you can pull up that specific webinar. But if you hire an employee who's W-2, who is not an owner in the business, but they work 1,000 hours or more in your business during a 12-month period, then after that 12-month period is up, meaning that that W-2 employee has both worked 1,000 hours and that full 12-month period, you're going to have to close the plan down as well. You won't be able to continue with the plan anymore. So that's another scenario. And again, we're going to get into what your options are once you meet these requirements to close the solo 401k plan. Another instance is if you hire long-term part-time employees. Now, this rule didn't come into place till Secure Act 1.0, which it used to be a 3-year period, and then Secure Act 2.0 changed it to 2 years. So essentially, what the 2-year period says is that if you hire a W-2 employee in your business, again, who is not an owner, so someone who's a common law employee working as a W-2 employee, if you hire someone that is a W-2 employee and he or she works between 500 and 999 hours for 2 consecutive years, so 2 consecutive 12-month periods, then you're going to have to close the plan down as well. So you've got the full-time W-2 employee route to contend with, and thanks to Secure Act 1.0 and then subsequently Secure Act 2.0, now you have the 2-year long-term part-time employee route to contend with. So these are rules to understand. So those are the typical instances where individuals decide to close a solo 401k plan down. Now, a fourth scenario, which I didn't list here, is you'll have a individual or a business owner wanting to close their solo 401k plan down because they no longer want to sponsor a solo 401k plan through their business. Well, typically you're not supposed to close a plan down until you're either age 59 and a half, no longer self-employed, or you meet the requirements here. Those are called the permanent requirements. The permanent requirements basically is a way of the IRS saying that whoever sets up a 401k plan, you're supposed to do it with the intention of having it for the foreseeable future, for as long as you're still self-employed or working and you are not retired. But if you do close that plan down, then that's another event. But when you close a plan down because you no longer want to have your business sponsor a plan, then that generally will result in what's referred to as the cooling off period, where you're going to have to wait 12 months. It's also known as the successor plan rule. You're going to have to wait 12 months after you close that solo 401k plan down to open up another one. The IRS provides those regulations to keep people from flipping solo 401k plans. So opening and shutting them down and then opening them again. So that's called the successor plan rule, oftentimes referred to more commonly as the cooling off period, where you have to wait 12 months before you can open up another solo 401k plan. Okay, now let's take a look at the other slide here. Keep in mind that, again, if you hire full-time W-2 employees in your business, or you meet that long-term part-time employee rule where you hire a W-2 employee who works for 2 consecutive years, then you have to close the plan down. Now, the following individuals can be excluded from participating in a solo 401k plan. So it doesn't matter how many hours they work, whether they work 1,000 hours or more, 500 hours or more, under that amount. You can exclude these individuals from participating in the solo 401k plan. So those who are under age 21, so you may have a son or daughter who works in your business as a W-2 employee, he or she is not an owner. Well, you can exclude that individual from participating in the plan if they're under age 21. And even if they work 1,000 hours or more, it's not going to impact your eligibility to continue with that solo 401k plan. You can also exclude union employees and, of course, independent contractors. Let's say you're self-employed business, you hire contractors to help with your business. If they're truly independent contractors, then you can exclude those independent contractors as well from the solo 401k plan. So they can work as over 1,000 hours and you can still continue with the plan. Okay, looks like we've got some questions here. Let's take a look at some of those questions and then we'll continue with today's topic, which is, when can you close a solo 401k plan? Oh, here's a good question. We get this question quite a bit. I'm glad it came up. Is it possible to use rule of 55 with the solo 401k plan? I've been told no. Great question. You essentially cannot use the age 55 rule when making a distribution from a solo 401k plan. Why? Well, with the age of 55 rule, that means that you can take distributions from a 401k plan before age 59 and a half. So that's the purpose of the rule of 55, is to be able to take distributions from the plan prior to age 59 and a half without having to pay a 10% early distribution penalty. The 10% early distribution penalty applies to those who are age 59 and a half or older. You're always going to have to pay taxes. There's no way around that, specifically if you're distributing funds from the pre-tax solo 401k. Those funds have never been taxed. So regardless of your age, you're still going to have to pay taxes, federal taxes, just not the 10% penalty if you're age 59 and a half or older. And you may also have to pay state taxes depending on your state of residence. But the age of 55 applies to full-time employer 401k plans, where you separate from service. In other words, you no longer work for that full-time employer that sponsors the plan. That plan still continues after you separate, because obviously, just because you no longer work for that employer, that doesn't mean that the business is closing down. That's not your business. You're an employee of that business. You don't own that business. So that plan is going to continue. So that's why the age of 55 rule applies to those full-time employer plans, because you leave that employer when you're age 55, and therefore you're not going to have to pay a 10% penalty if you take a distribution from that traditional full-time employer 401k because of the age of 55 rule. Well, with the solo 401k plan, when you want to utilize that age of 55 rule, that means that your business is going to continue. So your business is not closing down, right? So when you distribute from a solo 401k plan under the age of 55 rule, that means that now you're going to have to continue with that plan. And because you have to continue with that plan, you're not going to be able to exercise that age of 55 rule, because when you distribute funds from a solo 401k plan, you generally have to be age 59 and a half. That age of 55 rule is if you separate from your employer. Again, when you separate from your self-employed business, your business is shutting down. So you're going to have to close your business down, and therefore you're going to have to close the plan down. So that's why that age of 55 rule does not apply to solo 401k plans. Let's see if I think we have a lot of posts on our community surrounding the age of 55 rule. See if I can dig something up here to share with you so that you can look at it a little bit more closely. Yeah, here we go. We've got a good page on here. If I can share with you. Okay, here's the link to that. Take a look at that link there so you can learn more about it. I just shared it there. So, we have another question here from VP. I have a solo 401k with you, about to make lump sum contribution into two buckets, traditional and after tax. What information documentation do I need to provide to you for tracking reporting purposes? Great question. We get this question so often that if you go to our homepage, we have a section titled "This Week's Top 7 Visited Websites," and one of the website pages that's visited the most on our website is how to report contributions. Let me share that link with you, and then I'll answer your question as well. So reporting solo 401k contributions, that's not reported to my solo 401k financial. Instead, those are reported on your tax return. Here's the link to that page, how contributions are reported. So the contributions are going to be reported on your personal and or business tax return. If you look at that link, there's a nice cheat sheet there that gives you a line-by-line number as to where to report the contribution type. So that's number one. Number two, the solo 401k holding accounts. So the bank or brokerage account also serves to track those contributions. That's how contributions are tracked. That's why with the solo 401k, you are required to have separate holding accounts for each source of funds and for each participant in the plan. Take a look at the slide here. Here's an example of a one participant plan. So you would have three separate bank accounts or brokerage accounts under that solo 401k plan to hold the various source of funds. So one plan, you'll have a pre-tax bucket, aka bank or brokerage account, holding account, a Roth, and a voluntary after tax. So three holding accounts. So for example, let's say Jake is self-employed under an LLC. He opens a solo 401k plan, so the plan is sponsored by the LLC. So just one plan. Jake wants to be able to make pre-tax contributions, Roth contributions, as well as voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. So he opens up three bank or three bank accounts or three brokerage accounts under that plan to hold those respective funds. This slide here gives an illustration of a two-participant plan. Let's say both spouses are self-employed in the same business. Let's say Jake and Sally are self-employed in an LLC. They both want to contribute to the plan. Well, a solo 401k plan is a defined contribution plan. It is not a defined benefit plan. Therefore, because it's a defined contribution plan, you have to have separate buckets to track each participant's funds and their fund sources. So that's why here you see two participants, so Jake and Sally, they each have three separate brokerage accounts or bank accounts under that same solo 401k plan to hold their respective funds. So a total of 6 holding accounts. Now, not to get off topic here, but I want to give you a little warning here. I've been notified here in the last few months that there are some solo 401k plan document providers out there that are trying to charge you more money by saying, hey, even if you're both participating in that same solo 401k plan, you have to open up 2 separate solo 401k plans. And they do that so they can charge you 2 double setup fees. So be mindful of that. And that's actually not even allowed under the IRS regulations because you're both working under the same business. So it's just one plan. That's something it's a little dumbfounding that you've got solo 401k providers promoting that you can have 2 separate solo 401k plans when both spouses are working in the same business, and they're doing that just to charge you more money. And I've noticed that there's been a couple others who have jumped on that wagon. So yeah, it's pretty bad, but not to get off topic too much. So to finish answering your question, that's how you're going to report the contributions on your tax return. Now, if you're doing the mega backdoor Roth solo 401k strategy, that's where you're making a voluntary after-tax solo 401k contribution. And then you want to convert that immediately to the Roth solo 401k or the Roth IRA. Then that's going to trigger reporting such as a Form 1099-R. A Form 1099-R applies when you convert pre-tax solo 401k funds to the Roth solo 401k, or if you convert voluntary after-tax solo 401k funds to a Roth IRA or the Roth solo 401k. And a Form 1099-R is issued by January, February of the following year when that conversion occurs. So if you process a conversion here in 2025, then you would complete our online conversion form so that we collect the necessary information to report the conversion of those pre-tax solo 401k funds to the Roth solo 401k, or the conversion of voluntary after-tax funds from the solo 401k to the Roth solo 401k or the Roth IRA. And you can find that form on our forms tab. You can submit the form that we use to collect the information to issue that 1099-R to process conversions or even distributions. Here's the link to that form page on our website. So good question. Okay, let's see if we have any other questions here. Here's a question here. Who issues Form 1099-R for after tax to Roth? Is that you or Fidelity? Great question. No, that would be issued if you're a client of my solo 401k financial, we'll issue the Form 1099-R because we're the plan provider and we provide that service. I know there are many providers out there that charge extra money for that service. We don't charge additional fees for Form 5500 Easy or Form 1099-R reporting as long as you timely request it. And we're the ones that would issue it if you're a client, because the bank or brokerage firm, including Fidelity, that holds the funds for the plan that we offer, will not perform that reporting. I know some providers out there will charge you more funds or they'll tell you how to do it, but they fail to tell you that you also have to report it with the IRS on a separate form known as a Form 1096 if you do it yourself. So you got to do double the work. Not only do you have to report it to the IRS separately on a Form 1096 using a special carbon copy that they provide, but you also have to issue a 1099-R. Well, here at my solo 401k financial, we issue both the 1096 and the Form 1099-R. And there's a form on our website that you would fill out, and I'd share the forms tab if you process a conversion of voluntary after-tax solo 401k funds to the Roth solo 401k. let me pull up the Fidelity procedure. Since you're a client and you utilize Fidelity to hold your solo 401k funds for the plan that we offer, let me pull up a specific link to your situation. Give me a moment here. And I'll dig that up and I'll share that link. Okay, here's the link here. It references the form Fidelity needs to have the funds moved, as well as the process, as well as the link to our form that you would complete after you convert the funds from the voluntary after-tax solo 401k to the Roth solo 401k so that we know what the amount that you converted was. So take a look at that. Here's the link here that you can review. Okay, so let's take a look at some more information on today's topic, and then we'll continue to monitor the chat here for any questions. Go ahead and type over your questions during the daily webinar, and we'll pause and answer those questions as they come in. Please also like our video today, subscribe to our channel to help get the word out to other solopreneurs like yourself. And also you'll receive notifications when we go live. Let's get back to our slides here. So again, today's topic is when you can close a solo 401k. We already discussed these various instances of when you would be required to close a solo 401k plan. We just went over that a few minutes ago. We also talked about who you can exclude from participating in the solo 401k plan. And even if these individuals work for your business, you can still continue with the plan. So let's talk about the IRS requirements when closing a solo 401k plan. So you need to consider the following when you decide that you need to close your solo 401k plans because of the events that we discussed earlier. So you need to consider if your solo 401k plans holds both pre-tax and Roth solo 401k funds. If it does hold Roth and pre-tax solo 401k funds, and you're closing that plan and you want to transfer it to an IRA, you're going to have to open up two separate IRAs. You're going to have to open up a traditional IRA and a Roth IRA. And that's if you don't have any traditional or Roth IRAs already, of course. If you already have Roth IRAs or traditional IRAs, you can transfer the Roth solo 401k and the pre-tax solo 401k to those respective IRAs. But if you don't currently have any IRAs, you're going to have to open up at least two IRAs, a traditional IRA and a Roth IRA. And if both spouses are participating in the same solo 401k plan and the plan is closing down, you're going to have to open up a total of four IRAs, because an IRA stands for individual retirement arrangement. More people refer to it as an individual retirement account. So you would need, so that's for an individual. So that's why you would need four IRAs, two Roth IRAs and two traditional IRAs for each spouse, if they're both participating in that plan and therefore have funds in the plan. Now, you need to determine whether or not you have any outstanding solo 401k participant loans. So a participant loan is when you borrow from the solo 401k plan for personally. Unlike an IRA, you can borrow from a solo 401k, and that's known as a solo 401k participant loan. You can borrow 50% of the total balance, not to exceed $50,000, and each participant in the plan can borrow that threshold amount, and it's based on their respective funds. And you're supposed to pay it back monthly or quarterly, spread out over that 5-year period, or it can be a 15 or 30-year period if you utilize the funds towards the purchase of your primary residence. Well, when you're closing a solo 401k plan, and if you have an outstanding loan and you're trying to transfer the plan funds to an IRA or IRAs, then you're going to have to pay off that loan. And if you're a client of my solo 401k financial, our plan allows for participant loans. And when we draft the plan loan documents, including the payment schedule, and there's a tab on the payment schedule that where you can check off the loan payoff amount. So you can verify that loan payoff amount. So you have to pay that loan back with interest and principal before you close that plan. Otherwise, that outstanding loan will be treated as a taxable distribution, and you're going to have to pay taxes on the outstanding loan balance. So it's important to make note of that as you're planning the closure of your plan. Another item to understand is, does the solo 401k plan hold any investments? Whether we're talking about equities like stocks or exchange traded funds, index funds, or does it hold alternative investments like private funds, like private equity, real estate syndicates, physical real estate as well? Does it hold physical real estate? Because if the fund does hold physical real estate, then that in-kind transfer of that solo 401k assets to a self-directed IRA, for example. So if you hold cryptocurrency or a physical real estate, then those positions would be transferred in kind to that self-directed IRA so that you don't have to liquidate your positions. So keep that in mind. For example, let's say you hold a rental property and you're closing your plan. You're going to want to open up a self-directed IRA and have that property from the solo 401k granted in the name of that self-directed IRA custodian for the benefit of your IRA. And you would work with the county recorder and having that property granted in the name of that self-directed IRA custodian. So you need to first open up that self-directed IRA, obviously, with that self-directed IRA custodian. And then that property would get transferred in kind to that self-directed IRA. Same thing with the private fund. Let's say you invested in the private equity fund. You would need to work with the sponsor of that private equity and having those private equity records updated to list that your self-directed IRA custodian for the benefit of your IRA is now the owner in that investment as opposed to your solo 401k plan. Now, you could also, like I said, if you have equities like stocks in your solo 401k, you don't have to open a self-directed IRA. You can open up a traditional IRA at a brokerage firm like Fidelity or Schwab, and those solo 401k equity stocks, for example, can be moved over in kind to that IRA so that those positions are now liquidated, especially if you have a stock that's performing really well. You probably don't want to sell it. Okay, so those are things to understand. Give me a moment here. Let me share some. I think we may have some more questions here. Let's see here. It looks like we have a follow-up question. So for the money movement, I'll ask Fidelity to put money into after-tax account and then immediately move it to the Roth account, correct? This is for mega backdoor after tax. Is that the correct flow of money? That's exactly right. If you're converting the voluntary after-tax solo 401k contribution to a Roth solo 401k, so the Roth solo 401k bucket. So for example, you're going from, let me pull up this slide here. Give me a moment. So you would make the contribution to this bucket here, the voluntary after-tax solo 401k, in your case, the brokerage account at Fidelity. You would then immediately convert it to the Roth solo 401k plan, so that bucket there, as soon as you make that contribution, so that if there are any small gains, and those gains get converted over, because you got to convert everything in that account, only the small gains will be taxable, but not the basis. And then you'll complete our Form 1099-R after Fidelity moves those funds. As far as how to have Fidelity move those funds. I shared a link with you earlier. Let me share it again here. You're going to have to fill out Fidelity's form to request them to internally move those funds over. You can also call Fidelity and you can ask them to move those funds over the phone. They'll move them over the phone for you from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket. So there's the link to the form if you use a form to do so, or you can call Fidelity and have them do it over the phone. Okay, let's see here if we have any other questions here. Again, please like today's video. Please subscribe to our channel to help get the word out to other solopreneurs like yourself. Got a question here again. I'm under 50. I'm planning to contribute $5,000 to my work retirement plan. They match $5,000 in 403b. Can I contribute $60,000? So the $70,000 minus the $10,000, all into after tax. Great question. So if you contribute $5,000 of personal money, or I should say, if you contribute $5,000 of employee contributions to that 403b employer plan, and then that 403b employer does a match of $5,000, so a total of $10,000, then you are correct. You have to reduce your overall contribution amount to the solo 401k plan, which is $70,000. You have to reduce that by the amount of contributions made to your 403b, whether employee, employer, or both, from that 70,000 overall limit. So you would only be able to contribute $60,000 to the voluntary after-tax solo 401k and then convert it to the Roth solo 401k or the Roth IRA. Of course, you have to have the necessary self-employment income to justify any contribution amount, including that $60,000 amount. So it takes earned income from self-employment in order to contribute to the plan. And you're saying here, or do I have to hit the 23,500 either in pre-tax or Roth before going to after tax? No, great question. When you make contributions to a solo 401k plan, that's the great thing about it, is that you can choose to solely make voluntary after tax solo 401k contributions. Many of our clients solely make voluntary after tax solo 401k contributions because they want to utilize the mega backdoor Roth solo 401k strategy. So they'll make the full $70,000, or in your case, the full $60,000 as a voluntary after-tax solo 401k contribution, and then immediately convert it to the Roth solo 401k or the Roth IRA, and therefore you can't make any more employee or any employee or employer contributions to the solo 401k because you will have exhausted the overall contribution limit to the solo 401k plan. In other words, the overall contribution limit to a solo 401k plan, which is $70,000 for tax year 2025, consists of employee, employer, and voluntary after-tax solo 401k contributions, meaning you can now go over that $70,000 in aggregate between all those sources. But yes, you can choose to solely make voluntary after-tax solo 401k contributions up to that overall limit and forgo the other contribution types. Hopefully that answered your question. All right. We've got a question here from Scott. You set up the 3 sub-accounts at Fidelity. When I tried to buy stocks from the pre-tax sub-account, the account does not appear on the list of accounts to trade on. What am I missing? So whenever the brokerage accounts at Fidelity are first open for the solo 401k plan, you have to go in there and nickname those accounts. They're open with a 0 balance. So you'll go in there, and as long as they all have a 0 balance, you can nickname those Fidelity brokerage accounts. You're going to label those brokerage accounts as follows. Let me share my slide here. So you're going to label, the first one will be labeled pre-tax, the second one Roth, and the third one after tax. That's the voluntary after tax bucket. So you need to nickname those Fidelity brokerage accounts, and you can do so. Let me provide a link that you can follow instructions for nicknaming those Fidelity brokerage accounts, and you can log into the Fidelity to your Fidelity brokerage accounts and nickname those accounts. Okay, let me share that with you here. Give me a moment here. We have a step-by-step instruction on how to do that. That way you're going to know which one is which when you do trading. Okay, so there's the link there for nicknaming those brokerage accounts at Fidelity for the plan that we offer. So good question. Okay, it looks like no other questions at the moment. Let's continue with today's webinar, which is when can you close a solo 401k? Again, please like today's video to help get the word out to other solopreneurs like yourself. And in the meantime, let's get back to our slide deck here. So we just talked about how you need to be aware of these following items here when planning on when you're closing your solo 401k plan. You got to determine whether you have both pre-tax and Roth solo 401k funds, whether you have an outstanding solo 401k participant loan, whether your solo 401k plan holds equities or alternative investments. So we talked a great deal about that. So let's continue here. So let's talk about IRS require reporting. So when you close the solo 401k plan, the government requires specific reporting performed so that the plan gets formally closed with the government. The first one is you have to issue a Form 1099-R. And a Form 1099-R is a way of communicating to the IRS what occurred with those funds in the solo 401k plan. Were they moved to an IRA? Did you take a taxable distribution, for example? Both of those instances require a Form 1099-R. Likewise, did you transfer it from the solo 401k plan to your full-time employer plan? Let's say you're working for another company now that offers a 401k. When you transfer that solo 401k to that full-time employer, that also results in having to issue a Form 1099-R. One instance where a Form 1099-R does not apply is if you restate that solo 401k plan to your own full-time employer plan. Let's say your business grows and you've employed some full-time W-2 employees, but you still want to participate in a 401k. So therefore you open up a traditional 401k for your business. So your solo 401k plan would get restated to that full-time employer plan. And when you restate a solo 401k to your full-time employer plan for your own business, so this is a business that you provide for your full-time employees, where you provide a 401k. When the solo 401k gets moved to that type of plan, that does not require a Form 1099-R or a final Form 5500-EZ to be filed. But don't confuse that with transferring a solo 401k to an employer that you work for that is not your business. That does require the issuance of a Form 1099-R. Also, a Form 5500-EZ has to be issued when you close a solo 401k plan, whether it's a distribution or a transfer, regardless of value. Unfortunately, there's misconception out there that if the market value of your solo 401k plan is under $250,000 and you close the plan, that you don't have to issue that final Form 5500-EZ to close the plan with the government. Well, that's flat wrong. You are required. That $250,000 filing threshold applies to plans that are active. In other words, you're not closing your solo 401k plan. And if the market value of your solo 401k plan is over 250,000, then you have to file a 5500-EZ. But if it's under, you don't. if you have an active plan. But if you're closing the plan, regardless of value, you have to file that final Form 5500 easy. And the penalties are really hefty if you don't file that Form 5500 easy. I mean, the IRS actually increased the penalty amount with the passage of Secure Act 2.0. Now you have to pay $250 per day for missing that filing of that Form 5500 easy. So that can compound awfully quickly to tens of thousands of dollars. So again, that Form 5500 easy has to be filed. And if the IRS catches that you didn't file that without you coming clean on that, you're not going to be able to get any type of relief. You're going to be subject to those tens of thousands of dollars in late filing penalties for not filing that Form 5500 easy. And the IRS is going to catch it eventually. They can catch it very easily. All they have to do is wait for that 1099-R that was issued to flow through their system. If the funds went into an IRA, that IRA custodian is going to issue a Form 5498 that reports transfers into IRAs as well as annual contributions. And that's when the IRS will catch it, which is typically a year later. So multiply 365 times $250. I'll let you do the math there. So I can't stress enough how you are required to formally close a plan with the government by not only issuing Form 1099-R to report the movement of the funds, but you also have to file that final Form 5500 easy. The great thing is that for clients of my solo 401k financial, we provide that reporting at no additional cost. That's included in our annual fee, providing you timely request those returns. All right, so that covers that bullet point. Let's see here. As far as timing, so from a timing perspective, that deals more with investments. Let's say you've got some investments in your plan, or you have an outstanding solo 401k participant loan, and you want to, and you're closing your solo 401k plan down. Well, you need to make sure you pay off that solo 401k participant loan first, so that you don't get taxed on the outstanding loan balance. Because as I mentioned earlier, that'll be treated as a taxable distribution. Also, if you hold some investments that you're planning to sell, you're going to want to sell those investments so that way you can process the closure of the plan by year end. Also, you have to consider, we talked earlier about if you hire a full-time W-2 employee in your business, that's not an owner. That requires the closure of the plan once that individual has worked both 1,000 hours and 12 months in your business. So you got to make sure you time that 12-month period. Same thing with if you employ long-term employees, part-time employees who work 500 to 999 hours for 2 consecutive 12-month periods. You got to make sure you know when that clock starts and ends, because then you got to close that plan down. So those are very important things to understand. Looks like, let's see what else we have here. So let's talk about the steps to take to roll funds out of the solo 401k plan, because again, you qualify to close the plan down. So you need one of these scenarios here that we discussed earlier. So first, you want to pay off that solo 401k participant loan if you have any outstanding loans. You then need to make sure you're current on your solo 401k annual fees. You then need to make sure that you pay the final solo 401k fee, as that'll cover the closure of the plan. You then need to let us know that you want to move the funds to an IRA, for instance, so that we provide you with the necessary form to fill out, so that we collect the necessary information to issue that Form 1099-R and that final Form 5500 easy. You then will open up that self-directed IRA and move the funds to that self-directed IRA, including securities or investments, or you can open a traditional IRA if you don't hold any alternative investments like real estate or private equity. You just need a traditional IRA. Once you move those funds, then you let us know when you move those funds so that we can help you close the plan down with the government by issuing that Form 1099-R and Form 5500 easy. The Form 1099-R gets issued in January, February of the following year. the final Form 5500 easy gets issued in the following year by July 31st. So, for example, anyone that closes their solo 401k plan down here in 2025, a final Form 5500 easy will need to be filed by July 31st of next year, not this year, but next year in tax year 2026. The Form 1099R, if you close the plan down in 2025, that means you move all the funds out of the plan. Then the final Form 1099R would get issued in January, February of tax year 2026. So those are the reporting factors that come into play. Okay, let's see here. Looks like got a follow-up question here from Scott. I did rename the sub-account successfully. My issue is unable to buy stocks from the sub-account I renamed pre-tax. I understand now. So you just need to activate that trading feature on your account. Let me see if I have some information here that I can share with you on how to do that. Give me a moment here. If I can locate that. And I'll share that with you here. In the meantime, go ahead and type any other questions you have during today's daily webinar, and we'll cover those as they come in. And then please also like today's video, as it helps us to get the word out to other solopreneurs like yourself. In the meantime, I'm digging up that information regarding how to add that trading feature through your brokerage accounts at Fidelity. Give me a moment. Not easily pulling it up here. I'll tell you what I'll do. I'll send you an email since you're a client with that specific link so that you have it, and instructions as well. But it's pretty easy. You can do it through your login screen through Fidelity there. As a matter of fact, let's see here. I'm trying to locate your account here. Well, go ahead and submit a ticket on our website, and we'll go ahead and send you the step-by-step instructions. I don't have them at my fingertips here. Let me send you a link to our support ticket. Give me a moment. Okay, here's a link where you can submit a support ticket, and we'll go ahead and send you step-by-step instructions. Okay, it looks like we've come to the end of our session here today. I don't see any other questions. You can ask more questions when we go live here in a couple hours. We're going live twice today. Again, thank you for joining today's daily webinar. Until next time, have a great rest of the day.